The stock market is in a heavy decline over the last month, and the pain may not even be over yet. Welcome to my channel. My name is Cathie. Thank you for being here. Before we get started, please like and subscribe to my channel. Hit the notification bell. It really helps with the YouTube algorithm and helps me with my YouTube journey, and I really appreciate it. Thank you guys. I plan on starting a live streaming of me day trading every single day where I show you guys how I traded from $5,000 to $25,000 in less than 6 weeks using my simple trading strategies. I just finished this task no longer than 4 days ago. It took me 6 weeks, and I want to show you guys exactly how I did that. This way, you guys can also make up to $25,000 and start day trading as well. If you want this video series and you'd like to see how I did this, please make sure you guys subscribe to this channel and make sure you like this video. If this video gets over 1,000 likes, I'll start day trading live for you guys to watch every single day in the stock market. Now let's get started. The Nasdaq has closed below the weekly 200 EMA for the first time since the year 2000. Now, what does this mean? In the year 2000, we had something known as the dot-com bubble crash. This is when investors were investing in growth in these tech companies and these internet companies over everything else. This caused a huge rally in the market, which was not sustainable and caused a humongous crash years later. Now, if you look at this chart, you can see this is what happened after the year 2000, and this is how the stock market reacted to the initial stock market crash. Now, if we overlay that with what is going on today in the stock market and the Nasdaq, you can see this is where we would be right about here. This isn't to say that this is what's going to happen in the coming weeks to months, although the similarities are very similar, and it's hard to ignore. The Federal Reserve can change their minds at any time, meaning that they can stop raising interest rates, and that would cause a rally in the market. However, because our inflation rates are so high, I don't see that happening anytime soon. We do have some very strong indicators coming in the next couple days, tomorrow being the PPI and Thursday being the CPI. If you're not familiar, the PPI is a producer price index, which tells us how much producers can receive for a certain amount of goods. And the consumer price index is what consumers will pay for the same basket of goods, including rent and other commodities. Now, we can absolutely see lower lows if this trend continues. We're in a very strong bear market, a very strong bearish trend. And because we did cross the 200 weekly EMA and we closed below it last week for the first time ever since the year 2000, I can see us continue to sell off. I'm not trying to raise any alarms. I'm not trying to cause any panic, but I will say just be cautious. If you look at other indicators, such as the VIX, which is referred to as the fear or stress indicator, we haven't even reached the highs that we saw back in June when the Fed started raising interest rates for the first time. That's to show that retail hasn't even fully capitulated yet. Perhaps. We don't know that for sure, but it is a very strong indicator that we're not even fully sold off all the way yet. This can continue to keep going lower. Some other news that happened this week that are very important to the stock market and other markets. Cathie Wood did write a letter to Jerome Powell, the chairman of the Federal Reserve, asking him to stop raising interest rates. Now, we don't know for sure if this was because she needs to cover her ass or because she actually thinks the Federal Reserve is making mistakes by raising interest rates. In the letter, she wrote that she thinks that if they keep raising interest rates, some irreparable damage will be caused to the stock market. Now, if this doesn't sound exactly like what I just laid out for you with the dot-com bubble crash, I don't know what to tell you. It's something that hasn't happened in 21 years, possibly happening again for the first time since, is something to raise the alarm bells at. And if Cathie Wood is writing Jerome Powell because she thinks that he's making a grave mistake, there is reason to believe that this market could go lower. Something else that you might want to keep an eye out for is what the is going on with the British pound and the UK Bank of England. You may have seen some headlines recently that the Bank of England is going to be buying back UK gilts or government bonds to help support their stock market and their economy. Now, this is the exact opposite policy that the US is taking currently by raising interest rates and unloading their balance sheets. You might be asking yourself, why would the Bank of England be fighting against US monetary policy? And the answer to that, you need to know what's going on with the US dollar. The US dollar is seeing highs that it hasn't seen in over 20 years. It is now the strongest it's ever been in a very, very long time. And because of that, other currencies are showing signs of weakness, the British pound being one of them. It is costing more US dollars for the UK to purchase the same goods that they could buy before. When our dollar gets stronger, other currencies get weaker. That means the US dollar has weakened the UK pound. Now, in order to fight that and help support their currency, the UK is buying back government bonds to help funds, and other investors get out of the bonds before they decrease in value. The Bank of England's Governor Andrew Bailey just today announced they are no longer going to be supporting this and are going to be stopped purchasing government bonds or gilts coming this Friday. This has caused another huge decrease in the market. You saw a sell-off around 1 p.m. earlier today because of this headline news. Now, what does this all mean for our stock market right now? We have two key informational index reports coming out in the next couple days. Like I mentioned, the PPI and the CPI are coming out tomorrow and Thursday, respectively. Thursday is the day to watch out for because CPI data is what typically the Fed will look at for inflation. Typically, they use CPE instead of CPI. However, because this data report is coming out, the market will respond. If hotter inflation numbers come in, you can expect a large sell-off in the market come Thursday morning around market open. JP Morgan says they can see a 5% decline in the stock market if hotter than expected inflation numbers come in. If you follow me on social media, you can get more news like this on Twitter, TikTok, and Instagram, as well as put your notifications on, subscribe to my channel so that you get future videos coming from me in the near future. Like I said before, if this video gets 1,000 likes, I will also start day trading live stream on YouTube and Twitch so that you guys can follow along as I day trade. You can follow me on Instagram, Twitter, and TikTok at alex.cathie. Until next time, peace.